Then we have perpetuity. Then we have some other periods here. We have 5 years. You cannot compare amounts which are being paid or received in different periods. What you're supposed to do, it is to bring them to present value. Bring all these figures to present value. Bring them, all of them, to present value so that you can compare the figures at present value, in present value terms, and advise the investor accordingly. So the first thing, it is to bring the figures to present value and choose an option that provides us or gives us the highest amount in present value terms. You choose an option that gives us the highest present or rather amount in present value terms. That is what you're supposed to do in that question. So let's start with option A. Let's start with option A. Option A lump sum payment of shillings, lump sum. A lump sum payment of shillings 25.8 million, which will be paid after 5 years. N is equals to 5 years. Remember what we said? Present value of a lump sum. Present value of a lump sum. Present value of a lump sum is equals to the lump sum. Present value of a lump sum is equals to the future value times, let us use the tables. Let's use the tables. Times, but we said 1 plus r power negative n, which can also be written as future value is equals to present value interest factor r% power n. So in this case, we will have our 25 million times present value interest factor. Our r is 8%. Our r is 8%. So you say 8% power 5. 8% power 5. So this will be 25.8 million. Then you read this factor from the tables. Read 8% at period 5 from the tables. And you save time. You save time. I'm waiting for 8% at period 5. Yes. You do not have the tables? May I have the tables, but I want you to read. I want you to give me the factor. Like now what Alan has done. Alan, that is wrong. Alice, that is wrong. That is what I wanted. That is actually what I wanted, because this is a lump sum. This is a lump sum. So we are using the upper table, present value interest factor tables. This is a lump sum. What you're giving me is for an annuity. Yeah. So Edith, yours is 0.6806. Let me check. Yeah, that is right. 0.6806. We said a lump sum is that a payment. It's a payment or a receipt which occurs once. Like in this case, this person will be paid 25.8 million once after 5 years. After 5 years. That's why we are using this factor, because it is a lump sum. So multiply, get the answer. Multiply. We're taking too long. 17.55. 17.55 948 million. That is option A. Option B. Option B says what? Option B says a sum of shilling 16 million paid as follows. A sum of shilling 16 million paid as follows. So here, option B. We'll have year, amount, discount factor, you're using 8%, present value. So the first one, we are saying a sum of shilling 16 million paid as follows. 5 million payable today. Today is year zero. 5 million. 5 million shillings. Then 5.5 million paid to be paid after 1 year. After 1 year, they will receive 5.5 million. Next, 5.5 million to be paid after 2 years. So after 2 years, 5.5 million. This is what you're saying. If we can illustrate here, this is year zero, or not, this is now. This is in present value terms, today, present. Then we have year one, and we have year two. 5 million will be paid here, 5.5 million here, and 5.5 million here. That's what we're saying after 1 year. After 1 year, 5.5 million. After 2 years, this one and this one, 5.5 million. So here, the discount factor at present, at year zero, the present value interest factor is 1. Or rather, the factor here is 1. It is in present value terms. And that is what we are looking for. So here we will have 5 million. How about 8% at period 1, 8% at period 2? Note, just a minute. This is an annuity. This is an annuity. I will show you 2 ways of doing this. So but let's start with this. Use the upper table to get these figures here. Use the upper table to get this. Don't take too long to read these factors from the tables. And I want you to read for yourselves so that you can make mistakes and we correct those mistakes. So what is 8% at period 1? 8% at period 1. $0.9259. 0.9259. Year 2. Year 2. $0.85. 8573. So we multiply now. We multiply. So this is 5.09245. The other one is 8573. 4.73, that is 4.715, 4.71515. So then the amount here, the total amount here should be, so plus 5.09245 plus 5, 14.8076. 14.8076. That is the first way of doing that question. Or remember, this and these are annuities. The 5.5 million is an annuity because they are following each other. So here you can say this, or amount is the 5 million times 1, because that is in present value terms, plus 5.5 million times present value interest factor annuity 8% at period 2. 8% at period 2. So that will be, this is 5 million plus 5.5 times, we read 8%. So give me this factor. Give me this factor. %, present value interest factor annuity. Present value interest factor annuity 8% at period 2. There are two ways. I'm showing two ways, Akinyi. I'm going to explain this. So like now, Edith, you've got it wrong. It's 1.78, 8% at period to 1.7833. So multiply, see whether you're going to get the same answer as what we have above there. So this will be 5 times 5.5 times 1.7833. How much are you getting? Yeah, 14 points. Almost the same, 14 points. 14 points. 80815 million. So which is almost the same. So please note, when you're given cash flows like these ones, year 1, 2, 3, and 4, cash flows or amounts, you're told 100, 10,000. Let's go with 10,000. 10,000, 10,000, 10,000, 10,000. This is an annuity, but you can still use the upper table. You can still treat them as lump sums. Shadrach, yours is 14, or you're dealing with what? Millions. So I'm saying, and this is, I'm answering Akinyi. You're saying these are annuities, but you can still use the upper table to get the present value of this by having the factor at period 1, the factor at period 2, at period 3, and at period 4. However, there is a shortcut. There is a shortcut whereby you will say 10,000 times present value interest factor annuity R% power 4, this 4. That is a shortcut. But you can still treat them as lump sums and get the present value of each, like what we've done here. Is that clear? So annuity starts at year 0. Alan, what are you saying? Alan, Alan, annuity starts at year 0. Yeah, and ends at when? But we are told the amount is being paid at the end of year 1. Yeah, Alan, I'm saying it's being paid at the end of year 1. Here, remember, we talked about annuities that are paid at the beginning of the period and annuities that are paid at the end of the period. If we were told that the amount will be paid at the beginning of each period, it would have been an annuity due. It would have been an annuity due. But in this case, we've been told, let's go back to the question. It's also important to recheck. They're saying, a sum of shillings 16 million paid as follows. Shillings 5 million payable today, and today we have said this is year 0. Then 5.5 million to be paid after 1 year. So if you from today, you're being paid after 1 year. That means it is at the end of year 1. And the other one, 5.5 million to be paid after 2 years. So Alan, I believe that's okay. Okay, let's continue. So now you've seen the 2 ways of doing that question. Make sure and that is why I'm saying you have to understand. You need to understand. You don't need to just cram. No, you need to understand why this method is the same as this. If you had this and this plus this, it will give you this. Can you try this plus this? These two factors here, 0.925 plus 0.8573 must be almost the same as this factor. Because the annuities, we get annuities from the present value interest factor table. These things are related. They are related. I don't know. Let me check. Are you adding 0.9259 plus 0.8573? Yeah, almost the same. So that's why, because if this plus this is equals to this, then that's why we are picking just this and multiplying with this. So let's continue. Kindly, if you have a question, just ask. I want you to understand. Option C, annual payment of 1.4 for 30 years. For 30 years. Option C, this is annuity. That's an annual payment is an annuity. Of shillings 30 million? No. Of 1.4 million. 1.4 million. The period is 30 years. The period is 30 years. Our R is 8%. Then the first payment being made at the end of the year. The first payment being made at the end of the year. Now, look at this. This is a very good example, actually. Now, we've said here that you can either, no, let's come back here. We have 1, 2, 3, like in this case now, we're saying 1, 2, 3, 4, 5 for 30 years. For 30 years. And each year, they are paying 1.4 million. So what are they saying? 1.4 million each year. 1.4, 1.4, 1.4, 1.4, 1.4 up to 30 years. And we have said you can still treat this as lump sums and use the upper table to get the present value of this. But do you think that will consume a lot of your time? 30 times, 30 years, from 1 to 30. Then you multiply by each factor. Like in this case, you multiply, then you get the summation. That is a lot of work. That is tedious. That's why we're saying when it is an annuity, you do not need to use the upper table. You just get that figure, that annuity figure times the present value annuity factor. So here you'll say present value of annuity is equals to the annuity times present value interest factor, annuity, R% power N. Another important factor, another important thing in this question is option C, that is, in option C, we have been told that the payment will occur at the end of the period. The first payment being made at the end of the year. So this is an annuity that occurs at the end of the period, not at the beginning. So here you'll say 1.4 times present value interest factor annuity, 8% power 30, because our N is 30. So read 8% at 30 years. Annuity. And kindly, if you're having a challenge, make sure you revisit these things or you ask. I want someone to read 8% at period 30, 11.2578. So the total amount multiplied by 1.4. Alice multiply by 1.4. $15.76 092 millions. And if you have a question, feel free to ask. Feel free to 8 million. A perpetual payment, that's an annuity first. That's an annuity of shillings 31.38 million. Period N is perpetuity. Remember how we get the present value of an annuity in perpetuity. Present value of annuity in perpetuity is equals to the annuity. You divide by what? R. So our R is 8, bado. R is 8%. So 1.38, you divide by 0.08. You divide by 0.08. So how much are you getting? $17.25 million. 17.25 million. Any question? Any question? Before we proceed? I want people to ask questions. Yeah, the table is always provided. The table is always provided. Both the present value interest factor table and the annuity factor tables. I don't know whether you can see here. This is an exam paper. You can see here, these are the tables. They are always provided. But you also need to be able to compute using your calculators. You should also be able to do using your calculators, because you can be given a factor, a percentage, a rate that is not in the table. For example, if you look at the table, there is no 17%. So if someone wants to bother you, they'll say 17%, and maybe it's not in the tables. Or 11, is 11 there? 11 is not there. So you should be able to compute using your calculators. For the annuity factor table, or rather, for annuities, we said is 1 plus R power negative N over R. That is for annuities. For interest factors, like in this case, which one? This one. Here we said it's 1 plus R power N. We get the same factor as when we are using the tables. It is always important to use the table, Alan, to minimize chances of making mistakes. To minimize chances of making mistakes, you'd rather go for the table rather than using the calculator, because you see, if you mess with your calculator, you are done. So it's always important to use, I recommend the tables when the rate is there. So I want us, or we want to advise. No, you have to say something. You have to say something. We said we go for the option that provides the highest amount. Option A, it's 17.5 million. Option B, it's 14 million, 14.8 million. Option C is 15.76 million. And option D is 17.25 million. So we go with option A. So we go with option A. The question was, assuming a required rate of return of 8%, advise on the payment option that you would select. So just say, I would select option A. I would select option A. I would select option A because it provides the highest amount, because it provides the highest amount in present value terms, because it provides the highest amount in present value terms, in present value terms. Is that okay? Okay, fine. Another question. Another question. So how was this question? Was it challenging or it was a straightforward question? The way you can see it. Yes? Okay, let's look at December 2023, question C and D. December 2023. December 2023. Question 3, C and D. Question 3, C and D. So December 2023. We start with question. No, we will not do C first. There is a bit that you're supposed to look at. That should be our next thing, the loan amortization. Let's look at question 3D. 3D. So that's December 2023. Question 3C is what we will do next. Are you there? The question reads, 𝐎𝐍𝐋𝐿 has the following investment options to choose from. So this person has the following investment options to choose from. Post office MIS scheme, monthly interest 8% per annum. Monthly interest 8% per annum. Next, ICD bank deposits, quarterly interest, 8.25% per annum. HDFC Limited, half yearly interest, 8.5% per annum. Required using effective interest rate method, advise 𝐎𝐍𝐋𝐿 on the preferred investment option. On the preferred investment option. So this is multi-period compounding and discounting. So you remember we talked about the effective interest rate, yeah? So effective interest rate, this is December 2023. Question 3C. Effective interest rate, we said is equals to 1 plus R over M power M minus 1. Power M minus 1, whereby we said power M is the number of times compounding occurs in a year. The number of times compounding occurs in a year is what we call in M. So now here, we start with the first one, post office MIS scheme. Post office MIS scheme. The interest rate here is 8% per annum. The payments here, it's monthly interest. So our M is 12. So effective interest rate is equals to 1 plus 0.08 over 12 power 12 minus 1. So how much are you getting? The effective interest rate for post office, someone give me the answer kindly. Save time, save time. You have a number of things to do. So 0.08299, call it 0.08, 0.083. So this is 8.3%. 8.3%. That is for the post office MIS scheme. Next, ICD bank deposit. The rate is R is 8.25% per annum. This is quarterly. Our M is 4. So effective interest rate is 1 plus 0.0825 over 2, not 4, over 4 power 4 minus 1. Whatever answer you get, multiply by 100. 8.51%. 8.51%. So we are multiplying by 100%, whatever answer we are getting. Next. Thank you for your answers, Alan and Stephen. HDFC Limited. Here, interest is half yearly, but 8.5% per annum. 2, and then effective interest rate, which is 1 plus 0.085 over 2 power 2 minus 1. %8.68%. %8.68%. Any question? Okay, now before any question, advise 𝐎𝐍𝐿 on the preferred investment option. Advise this person on the preferred investment option. Remember the question says, 𝐎𝐍𝐿 has the following investment options to choose from. This is someone who wants to invest. This is someone who wants to invest. So which investment option is better? The one that provides the highest rate is what we are supposed to adopt. That is option C, HDC. HDFC. So they're saying advise this person, advise 𝐎𝐿 on the preferred investment option. Say the preferred investment option, is HDFC Limited, since it provides the highest rate of return, since it provides the highest, say, effective interest rate. It provides the highest effective interest rate. The highest effective interest rates. Okay, fine. Now you can see there are questions from this topic of time value of money. And like I've said, you cannot handle these questions unless you get the concept. And I said, ensure you write your formulas every time you're doing these questions for you to be able to remember. So we will do more illustrations as we continue. So, but now, for now, just write loan amortization. Loan amortization. Loan amortization. Loan amortization. Loan amortization. Now, when you talk about a loan amortization schedule, Mwalimu, half yearly, should it not be 6 months? Yeah, and 6 months should be 2 years. Not 2 years, but 2 semi-annually. 2 halves, semi-annually. So you cannot use 6 months here. Whatever breakdown you're providing should add up to, it should add up to a year. Are we together, Stephen? You cannot use 6 months. You only need to divide. It's like hapa tumeambiwa quarterly. Quarterly we said 4 because in a year we have 4 quarters. Same case, we have 2 halves in a year. Yeah. So that is the case. So loan amortization schedule or loan amortization. Loan amortization, this is like, for example, loan. We're talking about loan amortization. If you acquire a loan from a bank or from any financial institution, we have the loan amount. The loan amount, let's say you've acquired a loan of shillings 1 million. This loan is payable after a period of 5 years. And this loan, you'll be charged an interest of 12% per annum. So what the loan amortization does, it helps us to understand how much should be the installment payable for this loan to be exhausted in a period of 5 years. So remember, when you acquire a loan, the repayment that you make must be it's the principal. You will pay the principal plus the interest charged. The total amount that you borrow. You borrowed 1 million. So that is 1 million is the principal. But you are going to repay the 1 million plus an interest amount that we don't know. Here you say X. That is the total amount payable at the end of the period. So, but we are asking ourselves, now that we've given this person a loan of 1 million shillings, payable within a period of 5 years, at an interest rate of 12% per annum, and whereby in repayment or in return, this person is paying a principal plus an interest amount. How much of an installment should this person pay within this period of 5 years to have exhausted, or rather to have exhausted the total amount within a period of 5 years? So I'm saying the loan amortization schedule helps us to determine the amount of installment payable by a borrower to the lender to exhaust a loan amount within a given period of time. Now, this one is very simple. The loan amount, because you're getting the loan today, you're getting the loan now. The loan is in present value terms. The loan is in present value terms. Then we have the installment. The installment, remember, they are equal installments paid within a regular period of time, or rather paid regularly. If it's monthly, monthly. If it's quarterly, quarterly. If it's semi-annually, if it's yearly, but an installment, it's a constant figure. So an installment is an annuity. An installment is an annuity. So with the present value here and with an annuity here, then it becomes very easy to determine what? It becomes very easy to determine to determine the installment payable in a loan. So this is what we do. We remember what we said. We said present value for lump sum, no. Present value for an annuity. Present value of annuity is equals to the annuity. Is equals to the annuity times present value interest factor annuity R% power m. That is what we said. So, but now we are saying the loan that you borrow is in present value terms. So this becomes the loan amount because the loan amount is the present value of the installments that you're going to pay, while the installments here become the annuities, or rather the annuities become the installment. That means if you want to get the loan amount with the installments, you can get the present value of the installment. The present value of the installments must be equal to the amount of the loan that you acquired. Yeah? I don't know whether we are together. I'm saying the present value of installments, the present value of the total installments that you are paying within the repayment period must be equal to the loan amount. So like in this case, whatever installments that we will have here, let's say like the installment is, let's say like it's a monthly installment, and we say 30,000 per month. So we are saying if you get the present value of these installments, they must be equal to the loan amount. And that is what we have here. So have this, write loan amortization, then you write this formula. And if you have a question, please ask. Don't try to ask questions. The definition of a loan amortization, it's just a schedule of depleting a loan. So, but you can say a loan amortization schedule, shows the interest charged, shows the interest charged for each period, shows the interest charged for each period, comma, installments paid, and the balance outstanding, at the end of each period, So in short, a loan amortization schedule, this is a schedule that shows how you are depleting your loan balance. Remember, the interest is charged on reducing balance basis. If the interest is being charged on reducing balance basis, it will show how you're depleting your loan balance, and the interest that you're paying in each period, and the installment. Again, this installment that we've talked about here, like this 30,000, it is not that you first pay the principal amount, then you start paying interest, no. Or you pay the interest first, then you start paying the principal amount, no. What you do, each installment as an element of the principal amount and an interest. Each installment that you're making consists of two things, and a portion of the principal amount and a portion of the interest charged. So you pay together until you exhaust the loan. Let's look at an example. April 2024, question 4C. April 2024, question 4C. April 2024, question 4C. So let me write here. April 2024, question 4C. And like I've said, do not shy to ask questions. This one is very important. April 2024, question 4C. So a company negotiates, the question reads, a company negotiates a shillings 30 million loan for 8 years from a financial institution. The interest rate is 14% per annum on the outstanding balance of the loan. The principal and interest will be repaid in 8 equal year-end installments. Required, prepare a loan repayment schedule And 2, determine the amount of interest payable at the end of the 8th year. So let's look at that. And please make sure you follow. Make sure you follow. So we are saying a company negotiates. So this is April 2024. Question 4C. A company negotiates a shillings 30 million loan. So loan amount 30 million. 30 million. Then the interest rate is 14% per annum. 14% per annum on the outstanding balance of the loan. On the outstanding balance of the loan. The principal and interest will be repaid in 8 equal year-end installments. So the period here is 8 years. The principal and interest will be repaid in 8 equal year-end installments. Required, prepare a loan repayment schedule. So before, you cannot, the first thing, it's to determine the installment amount. You cannot prepare the repayment schedule if you don't know the installment amount. So we should start by getting the installment amount. Then after that, we prepare the repayment schedule. So, like we have said, you say loan, now present value of an annuity, present value of annuity is equal to the annuity times present value interest factor annuity R% power n. So we have said this is the loan amount, while this is the installment. This is the installment. So we say our loan amount is 30 million. Let's just have the whole 30 million here. 30 million is equals to installment times present value interest factor annuity 14% at period 8. 14% at period 8. 14% at period 8. So here we said that we are supposed to make this the subject. We are supposed to make this the subject of the formula. But before that, let's say 30 million is equals to installment times, read this factor from the tables. Read this from the tables. 14% at period 8. 14% at period 8 is how much? 14% at period 8. 14% at period 8. Someone kindly. 4.6389. 4.6389. 4.6389 is the factor, 14% at period 8. So remember, this is an annuity, eh? We are referring, the installment, we've said it's an annuity. That's why we are using the annuity factor tables. 46389. So then we divide both sides by what? This figure. So over 4.6389. 4.689 over 4.6389. So this and this will go. So installment is how much? Installment. So divide yes. 64, 67, 64, 67, 050, 050 point, let's say 38.38, 64, 67, 050.38. That is the installment. After getting the installment, now we can prepare the amortization schedule, the repayment schedule. So loan repayment schedule. Loan repayment schedule. So here we have period, amount due. Now let's say balance brought forward. Balance brought forward. This is balance brought forward. Here we will have interest. Interest is charged on the balance brought forward. We are charging interest at 14%. Here we will have the installments. Here we have the installments. And here we have the balance carried forward. That is at the end of that period. The balance carried forward at the end of that period. So we have period 1, we have the balance brought forward. So here we have period 1, 2, 3, 4, 5, 6, 7, 8. We have 8 periods. Then we have 8 installments. Now before that, how much have we borrowed? We borrowed 30 million. 30 million. 30 million is what we've borrowed. So let me do some spacing here. Let me do some spacing. So balance brought forward is what we've borrowed. So here we will charge interest at 14%. Here we will make our installments. And here we have the balance carried forward. Yes. So period 1, the balance brought forward is 30 million. We will charge interest on that. Then we will also pay installment at the end of period 1. We are going to pay an installment. After we pay an installment, there will be a balance. So say this is A, this is A, this is B, this is B, this is C. So this is A plus B minus C. The balance carried forward is A plus B minus C. Remember, the installment reduces the amount of the loan, but interest increases the amount of the loan. Now, here the installment is 64, 67, 050.38. Remember, the installment remains the same till the end of the period. So we will have 8 installments of this figure. So let's have 64, 67, 050.38, 64, 67, 050.38, 6467, 050.38, 6467, 050.38, 6467, 050.38. That's the sixth installment. 64, 67, 050.38. And the last one, 64, 67, 050.38. How do you know that you are correct? The last installment should exhaust the loan balance. So here, when we make the eighth installment, it should exhaust our loan. So here we will have nothing. Here we will have nothing. So let's start now. I want to believe you have that. Do you? I want us now to start doing the repayment schedule. Okay, fine. Let's proceed. Let's proceed. So the first one, for period 1, we are charging interest on 30 million. Charge 14% of that million for 20. This is 4.2 million. 4.2 million. Here, we're saying 14% of that million, 4.2 million. 4.2 million is the amount of interest charged in period 1. So this plus this minus this, we get the balance carried forward. This plus this minus this, get the balance carried forward. So this is 30 million plus 4.2 million minus 6467 050.38. I'm getting 27 732 949. Yes. 27 732 949.62. The balance carried forward at the end of period 1 becomes the balance brought forward in period 2. So this is 27 732 949.62. Charge interest again 14%. I'm getting 3882 612.95. 612.95. Yeah. Then plus the balance brought forward 27 732 949.62 minus our installment 6467 050.38. I'm getting 25 148, and kindly relook at these figures. 25 148 512.18. That should be 7. Eh? No, that's okay. Are you getting the same? Then here the balance should be 25, 148, balance brought forward, 148, 512.18. We charge interest on that. Charge interest on the balance brought forward. Which is 35.20. The interest charged 35.20. 35.20. 35.20. 791.71. 35.20. 791.71. Then plus the balance brought forward 25.1, 48, 512.18 minus 64.67, 050.38. I'm getting 22, 202, 253.50, which becomes our balance brought forward here. 22, 202, 253.50. Then times our interest again, we charge interest. Get 31, 08, 315.49. Then 22, 202, 22, 202, 253.5 minus the installment 64.67, 050.38. So 18, 843, 518.61. So here we have 18, 843, 518.61. Then we charge interest. $26.38, 092.61. Then plus the balance brought forward 18,843, 518.61 minus the installment 64.67, 050.38. So this is 15, 014, 560.83. 15, 014, 560.83. Then we charge interest 2102, 038.52. And I believe you are all doing this, because if we get it wrong somewhere, then it will not be good for us. 10,649 is the balance here. 10,649, 548.96. 548.96. That is the balance brought forward here. 10,649, 548.96. Then we charge interest on that figure. We get 1490, 936.86. Add to a balance brought forward 10, 649, 548, 10, 649, 10, 649, 548.96 minus the installment 64, 67, 050.38. 5673, 5673, 435.44. 5673, 435, 5674, 435.44. So 5673, 435.44. Then times 14%, 794 to 80.96. 794 to 80.96. 56, 73, 435.44 minus 64, 67, 050.38. We're getting a balance of 666. That is because of rounding off. That is because of rounding off. So that should be okay. Any question? So yes, Alan, I'm getting the same, a balance of 666, which should be attributed to the rounding off effect. So that means the last installment, okay, the bank will know how to recover the 666. So, but that is what a loan repayment schedule looks like, or a loan amortization schedule. Any question? Any question? Any question? Okay, you can even write the 000. But yeah, you can put the 666 there. Still okay. You can also put the 0. Still okay. The most important thing is how you've been able to tabulate all this. Yeah. So you can do the 666 there, because the bank will recover that amount maybe the following month. You can do 666. But my intention was to show that after the last installment, we should have exhausted our loan balance. Now, we have part 2 of that question. Determine the amount of interest payable at the end of the 8th year. Determine the amount of interest payable at the end of the 8th year. This one. This is the amount of interest payable at the end of the 8th year. At the end of the 8th year. So interest payable at the end of the 8th year, it's 794 to 80.96. Interest payable at the end of the 8th year, 794 to 80.96. Any question? Okay, another question. December 2023, question 3C. December 2023, question 3C. December 2023, question 3C. So allow me to do away with this. Or we can maybe look at this first. No. Has everyone written this? Just let me do away with this. So we have an investor plans to borrow a loan of shillings 3 million to purchase a piece of land for his family. The interest rate agreed upon is discounted at a rate of 10% per annum. The loan is repayable in 4 years of equal installments. So 4 equal installments. Required amount payable per installment and a loan amortization schedule. So the loan amount is 3 million to purchase a piece of land for his family. The interest rate agreed upon is 10% per annum. 10% per annum. The loan is repayable in 4 years of equal installments. 4 years. Then amount payable per installment, like we have said, present value of annuity is equals to the annuity times present value interest factor annuity R% power n. So we have said this is the loan amount, this is the installment, this is the installment. So 3 million is equals to installment times present value interest factor annuity 10% at period 4. So 3 million is equals to installment times. So the factor here, 10% at period 4. 10% at period 4, we are using the lower table. 10% at period 4 should be 3.1699. 3.1699. So then you divide both sides. 3.1699. 3.1699. So this and this will go.
Yes, so basically in this case, a very quick recap on what you have said is that a deferred tax basically is a tax which the company was supposed to pay during the current year. That tax has been deferred, it will be paid in the future, or it is a tax refund the company was supposed to get during the current year that has been deferred. The company will be refunded that tax in the future. Now, we have therefore two types of deferred taxes: the deferred tax liability, deferred tax asset. So a deferred tax liability basically have said that this is a tax which is payable by the company in the future. We recognize that as an non-current liability in the statement of financial position. Deferred tax asset is a tax to be recovered by the company in the future. This one is recognized as a non-current asset. Now, on the other hand, we have said a deferred tax basically arises as a result of the difference between the accounting profit and the taxable profit. If these two profits are different, the accounting profit and taxable profit, that give rise to deferred tax. And basically, I've said the taxable profit is a profit which is computed by the company based on the existing tax laws. The accounting profit, this is a profit which is computed using the accounting standards and also the various accounting policies adopted by the company. Accounting policies include things like the methods of depreciation, how is the company depreciating its assets, and so on. So therefore, if these two profits are different, basically we are saying that will give rise to deferred tax. And basically with this small illustration here, we have said that we assume the taxable profit of the company is 30 million. The accounting profit or the profit before tax is 40 million. The tax rate applicable to this company is 30%. And then what you're required to do is we compute the deferred tax. Now, we have said that for us to be able to compute the deferred tax, the first thing we need to do is to determine the tax which was supposed to be paid during the current year. The tax which was supposed to be paid by our company should be 30% of its profit. And basically, in this case, I've said, when talk about profit generally, we are referring to the accounting profit. The accounting profit in this case is how much? 40 million. So the profit, the tax which was supposed to be paid will be 30% of the profit, which is basically 40 million. That will give us 12 million. But now we then need to ask ourselves, is this the actual tax to be paid by our company? Is this the actual tax to be paid by our company? Automatically, no. Because you can see, we have the taxable profit. In other terms, this taxable profit is different from this. So therefore, the actual tax to be paid by our company here will be 30% of the taxable profit. The taxable profit is what? Is 30 million. And that basically will give us what? Will give us 9 million. Now, the difference between these two figures there, the tax the company was supposed to pay, and the actual amount of tax to be paid by our company here, that is 3 million. 3 million, we refer to this as a deferred tax. We refer to that as what? As a deferred tax. Deferred tax, why? This, you can see during the current year, the year 2024, our company was supposed to pay a tax of 12 million. But the actual tax will be paid would be 9 million. This one being the accounting profit and taxable profit are different. It basically means that during the current year, the company has paid less tax than what it was supposed to pay. Now, this one will be known as a deferred tax liability. Will be known as a deferred tax what? Liability. Will be known as a deferred tax what? Liability. Is a tax the company was supposed to pay during the current year, but because the taxable profit is less than the accounting profit, this tax has been deferred, and basically it will be paid in the future. Now, as an accountant, the moment you are preparing the income statement, what you need to do, the moment you have to prepare the income statement here, the income statement, you should always start with the profit, or actually, once you have this profit before tax, like in our case, the profit before tax is 40 million. So to this, you come and you less the current tax. The current tax is the actual tax to be paid. The actual tax to be paid, this is basically what you refer as the current tax, and that is 9 million here, 9 million, 9 million. Also, you can see during the current year, our company has paid less tax with 3 million. Now, what you need to do as an accountant, in accordance with something called the prudence concept, you need to set aside 3 million from the profit of the current year to be used in terms of paying these taxes, tax in the future. That is in accordance with the prudence concept. Remember what prudence concept requires, that if you expect a loss to be, if you expect to incur a loss in the future, you need to provide for it today. You need to provide for it what? Today. So we make a provision for 3 million. To make a provision basically means that from this profit, we will set aside 3 million to pay the tax which the company was supposed to pay during the current year, but it has been deferred. It will be paid in the future. So basically, this one we refer to it as a deferred tax what? Expense. A deferred tax what? Expense. So that is not necessarily the tax which has been paid, but basically what we are doing, we are creating a provision. We are creating a provision. We know what is a provision. A provision, even from your salary, is where you set money aside to do something, to undertake a project you want to do what? To undertake in the future, or you want to implement in the future. So therefore, this is not a tax which was necessarily paid, but the reason why we are deducting that from the profit is purely to do what? To create a provision, to set aside 3 million to be used in terms of paying the taxes which are expected to be paid in what? In the future. In what? In the future. Now, in this case, or basically this difference between the accounting profit and taxable profit, that difference, the difference between the accounting profit and taxable profit, can actually be classified into two main categories. We have something called the permanent difference, and then number two, we have something called the timing difference. The timing what? Difference. So what do you mean by the timing difference and the permanent difference? Which we are saying is that difference between accounting profit and taxable profit. Now, first of all, when we talk about the permanent difference, this is actually the difference between these two profits. The difference between accounting profit and taxable profit. And what causes this difference? This difference is basically occasioned or basically caused by taking into account certain items of incomes and expenses in the computation of this profit, in the computation of accounting profit, but those items are not taken into account in the computation of taxable profit. In the computation of taxable what? A profit. In the computation of taxable what? A profit. So this one is caused by taking into account certain items of incomes and expenses, items of incomes and expenses, items of incomes and expenses only in the computation of the taxable what? A taxable profit, but those items are not taken into account in the computation of taxable profit. And automatically you know which are these items. Which are these items of incomes and expenses? These items are non-taxable incomes and disallowable expenses or non-deductible expenses. For example, what we know in computing the accounting profit, we may take into account expenses such as penalties, fines, amortization of assets. So all these are expenses, penalty, fines, and amortization. So we take into account all those particular expenses in the computation of accounting profit. But basically what we know in taxation is that those expenses are non-deductible or they are disallowable expenses. That's basically what we know. In computation of the taxable profit, you don't, or basically those items are not taken into account. We don't take into account penalties, fines, and amortization of assets, including impairment loss on goodwill. So automatically, that will give rise to a difference between, or make the accounting profit and taxable profit to be different. And that difference is known as what? The permanent difference. The permanent what? Difference. Now, we say that this difference basically does not give rise to deferred tax. And therefore, in the computation of deferred tax, this difference is what? Is ignored. This difference is what? Is ignored. So the question you may come across in addition to that in an examination setup is just whereby you're required to explain what is permanent difference. Sasa? Yes. Now, on the other hand, when we talk about the timing difference, this is the difference which is occasioned by taking into account items of incomes and expenses, items of incomes and expenses in the computation of two profits, the accounting profit and taxable profit, but in different accounting period. But in what? Different accounting period. Different accounting what? Period. Different accounting period. For example, in this case, you may be told that a company incurred a certain expense in the year 2024, and this expense will be taken into account or will be used in the computation of accounting profit, maybe during the year 2024. But this expense will only be treated as a allowable expense, maybe in the year 2026. So meaning that this expense will be used in the computation of the two profit, but in different accounting period. In computing the accounting profit, it will be considered in the year 2024. In computing the taxable profit, it will be considered in which year? 2026. Now, this is basically the difference which gives rise to deferred tax. Is the difference which gives rise to the deferred what? To the deferred tax. So the timing difference basically is the difference which give rise to what? Is the difference which give rise to the deferred what? Which give rise to the deferred tax. Give rise to deferred tax. As Anne is asking what? Assuming practically the company has excess what? Excess refund claim from KRA. Is the deferred tax asset? Is this a deferred tax asset? Is this a deferred tax asset? It all depends. Basically, if a company has a tax refund claim, so the company is claiming a tax refund. A tax refund claim is usually an asset. Is usually what? An asset. That is the first thing. But if, for example, you expect to recover this, or maybe you automatically, does KRA refund? Yes, maybe if you have the necessary documents, you can refund. But in most of the cases, you offset that maybe against the future what? Taxes. So usually we treat that as a deferred tax asset in case that amount of money is expected to be refunded beyond, for a period beyond 1 year. For a period beyond what? Beyond 1 year. But essentially, a claim for a tax refund is usually an asset. Is usually what? An asset. That's that? Yes. Now, in this case, I want us to look on some few terms. Basically, we're going to come across in the computation of deferred tax. We look on some few terms here. Definition of terms. These are also terms you may be required to define in an examination setup. Definition of terms. So the first term here is something called the carrying amount, abbreviated as CA, carrying amount. So what is CA? So this is the value of asset or liability in the statement of financial position. So that particular value at which an asset or liability is recorded in the statement of financial position, we refer to it as the carrying amount. We refer to that as what? Carrying amount. For example, we know that items of PP are recorded here at their net book value. So the value at which an asset or liability will be recorded in the statement of financial position is the carrying amount. Number two, we have the tax base. Tax base basically is the value of an asset or liability for tax purpose. For tax purpose. For tax what? Purpose. Let me give a good example of maybe an asset which qualify for investment deduction, or for an asset which qualify for what? For investment allowances. This is something you did in PFT. There are those assets which qualify for capital allowances. Now, if you happen, for example, to own such an asset which qualify for investment or capital allowances, and basically you sell that asset. You sell what? You sell that asset. For you to be able to determine the amount which you're going to treat as a taxable income, or the amount which you're going to treat as deductible expense, you take the sales profit minus the written down value. Minus the written down what? The written down value. There is a name, I think, which was given to this in taxation. I think trading, are they called trading receipt? Yes, something like that. So the difference between the sales profit and the written down value. So that amount is the one which is allowable or deductible in taxation. So therefore, in computing that amount which will be allowable or deductible in taxation, what do we consider as far as this asset is concerned? The written down value. So therefore, tax base is the value of an asset or liability for tax purpose. So the other term is temporary difference. Temporary difference. Now, temporary difference, abbreviated as TD, this is the difference. This is the difference between these two values. The difference between carrying amount and tax base. Carrying amount and what? And tax base. So in other terms, to compute the temporary difference, we take the carrying amount minus the tax base, of which in this case, we can either get a positive figure here, or we can get a negative figure. So if we get a positive figure, that one is called taxable temporary difference. If we get a negative figure, that one is called deductible temporary difference. So therefore, in that case, we can say we have two types of temporary differences. We have the taxable temporary difference. Actually, this one is abbreviated as TTD. Just understand, remember those abbreviations. TTD, taxable temporary difference, whereas this one is called the deductible temporary difference. Deductible temporary difference. So therefore, here we have two types. Types of temporary difference are two. We have the taxable temporary difference, and number two, we have deductible temporary difference. Now, a taxable temporary difference, we say is a taxable is a temporary difference, which gives rise to amount which are taxable in the future. So this give rise to amount taxable in the future. Amount taxable in what? In the future. And because it gives rise to amount which are taxable in the future, we can also say that this will give rise to, or it results to, something called a deferred tax liability. So we can say this gives rise to deferred tax liability. Deferred tax liability. This gives rise to the deferred what? The deferred tax liability. Remember from our introduction here, we said deferred tax liability is a tax payable in the future. Why do we have a tax payable in the future? Because the taxable temporary difference will give rise to amount which will be taxed in the future, which are taxed in what? In the future. So therefore, the TTD, taxable temporary difference, give rise to deferred tax liability. Now, a deductible temporary difference, this give rise to amount which will be allowable in the future. So this one give rise to amount which are allowable or deductible in the future. The amount which are deductible or allowable in what? In the future. In other terms, you can say that this give rise to a deferred tax asset. This will give rise to a deferred tax what? Deferred tax asset. I will try to simplify this because I don't want to go into details. So just understand what Morimo is teaching you here, that in case we have a taxable temporary difference, that give rise to deferred tax liability. That's just what you need to know. No need of going into details as to why that will occur. The deductible temporary difference, this give rise to a deferred tax what? Asset. Sasa, and also you need to remember here, we have those two types of temporary what? Difference. We have those two types of temporary difference. Now, the other term we can maybe define here. The other term we can also define here. Number 4, that is term number 3. Number 4, we have basically what you have already mentioned here. Deferred tax liability. Deferred tax liability. And from my introduction, you've already said that these are tax payable by the company in the future as a result of taxable temporary difference. Tax payable in the future. Tax payable in the future. In the future as a result of taxable temporary difference. As a result of what? Taxable temporary difference. So therefore, how do we compute this one? How do we compute the deferred tax liability? This is basically one of the formula you need to remember. How do we compute the deferred tax liability? We take the taxable temporary difference. The taxable temporary difference, we basically multiply that with the tax rate. We multiply that with what? With tax rate. That formula you need to remember. That is one of the formula we're going to apply. The other term, the last term you need to know how to define here is the deferred tax asset. Deferred tax what? Asset. So deferred tax what? Asset. Now, a deferred tax asset, basically, this is a tax which is recoverable in the future as a result of deductible temporary difference. So a tax which is recoverable in the future as a result of deductible temporary difference, as a result of deductible temporary what? Difference, as a result of deductible what? Temporary difference. So therefore, to compute the deferred tax asset, so this is the formula which we use. We take the deductible temporary difference, we multiply this with the tax rate. We multiply that with what? With the tax rate. We multiply that with what? With the tax rate. There is also something you need to recall from something I've explained here, that this one, that is the taxable temporary difference. The taxable temporary difference, remember what I've explained here. I've said that taxable temporary difference, this one arises whereby the carrying amount, this is very important, the carrying amount of either an asset or liability, this one exceeds the tax base. This one exceeds what? The tax base. So if you're given the carrying amount, you're given the tax base of the company's net asset, you get the difference, and actually you compare the two values, and the carrying amount happens to be more than the tax base, the difference is known as taxable temporary difference. But in this case, the deductible temporary difference, this one arises whereby the carrying amount is less than tax base. Is less than what? Is less than tax base. So if the carrying amount is less than tax base, the difference between the two values, carrying amount and tax base, is known as deductible temporary difference. And actually, we use that deductible temporary difference to do what? To compute the deferred tax asset. So I think, first of all, those are some of the terms you must be in a position to define. You may come across a question whereby you are required to define any of those particular two terms. You'll be able to see, I think there was a question some time back, which was requiring the candidate to differentiate between temporary difference and timing. Was it temporary difference and permanent difference? Permanent difference and the timing what? Difference. We'll check on that question. Then from there, once we proceed and basically look on the approaches used in computation of deferred tax. Approaches used in the computation of deferred what? Deferred tax. If a company is computing the deferred tax, either the deferred tax asset or the deferred tax liability, which approaches can be used? Here we have two approaches which the company can use. Number one, we have the income statement approach. Income statement approach. Now, under this particular approach here, the deferred tax is basically computed using the difference between the taxable profit and the accounting profit. So here we can say the deferred tax is computed using the difference between accounting profit and what? And taxable profit. And I hope you can be able to recall this difference between accounting profit and taxable profit, we have said is broadly classified into two: the timing difference and the permanent difference. But in this case, we have said that the permanent difference is ignored for the purpose of computing the deferred tax. So therefore, the difference which is considered here is the timing difference. In other terms, we can say that under this approach, we compute the deferred tax using the timing difference. We compute the deferred tax using the timing difference. Now, this particular method here is not recommended by this standard. So we can say IAS 12 does not recommend the use of this method, does not recommend use of this what method. For example, if you check on the questions which are tested nowadays, they always require you to use the other method, the other approach. So there is no question will come across. Maybe some questions which were tested some time back, the candidates were required to use this method, but questions which are tested nowadays, they require the candidate to use the other approach. So this method here is not recommended for use by the International Accounting Standard number 12. So we have the last approach here, or the last method, which is known as number 2, the statement of financial position. In other terms, is also called the balance sheet approach. The balance sheet approach. Now, under this method here, we compute the deferred tax using the permanent difference. What is permanent difference? The difference between carrying amount of tax base of various items of asset and liability. So we can say here the deferred tax. The deferred tax is computed using the temporary difference. Temporary difference is the difference between the carrying amount and the tax base of various items of asset and liability. So here we compute the deferred tax using the temporary difference, which is the difference between the carrying amount and tax base of asset and liabilities. And basically, this is the recommended approach. So we can say this is the recommended what approach? Recommended approach by IAS 12. The International Accounting Standard number 12 basically recommend the use of this what method. And I've said, if you check on all the past papers, the recent past papers, you'll be able to see that all questions coming from this, they usually require a computation of deferred tax using using this method here, using the balance sheet method, or basically the statement of financial position approach. I think basically that's what you need to know. Maybe the other concepts you need to understand, maybe I'll be able to explain more on that as we do an illustration. An illustration. Therefore, we will first of all take a short break. As we come back, there is a question I want us to do, a question similar to maybe a question there was a question which was in a file, and I think it was actually borrowed from the paper for AFR. That is a question I want us to start with, a question which was examined some time back, not too back. That is let me see the question here. Yes, so this is which sitting is this? November 2019, that is the question we are going to start with. Not actually, I'm saying these are questions which you came across in a PAL, CP intermediate level, because I think it was tested there. So November 2019, which is the question number what? Question number 5B. Question 5B. Question 5B. So we take a short break, 5 minutes or 10 minutes. We take a short break of 5 or 10 minutes. Yes, a break of 5 or 10 minutes. Yes, 10. We take a break of 10 minutes. We come back. Make sure you have that question with you. And then we do it maybe within the next 30 minutes, we'll be done. So see you after that short break. Yes, we continue. I hope you're back. Let's continue. Let's continue. Let's continue. Yes, so what are we told as far as that question is concerned? I hope you already have the question with you. Yes, do you have the question? Abdinasir, Mark. Do you have the question with you? And Daniel Douglas, do you have the question? Fred, Ismail, Reese, Mercy, Patrice, Phoebe? Yes. Okay. So what are we told in this question here? That is question number 5B. So the question is, Mafuta Limited has a deferred tax liability as at 1st of October 2018 of shillings 400 million. For the purpose of preparing financial statement for the year which ended 30th of September 2019, the following additional information is available. So basically we have number one, you told the company is available for sale financial assets with a carrying amount of 80 million and financial asset at fair value through profit and loss of 40 million. Both financial asset reported losses in fair value of 8 million each as at 30th September 2019. Number two, inventory is shown. Inventory is shown at the road of the cost and then realizable value. The cost is that 200 million, while the net realizable value is that 120 million. Number three, can someone share that question in the class WhatsApp group? Someone to share that question. Orangi, make sure you have those past papers with you. Make sure you have those past papers with you. Yes, number three, we are told receivables had a carrying amount of 2,000 million after making allowance for doubtful debt of 80 million and an exchange gain of 60 million, which is not yet realized. Both allowances and exchange gain are not allowed for tax purpose. Number four, trade and other payables are stated that is 600 million after making provision for discount of 40 million. Five, a property, plant and equipment has a carrying amount of 4,800 million and a tax base of 4,000 million. Some rented buildings were revalued upward by 200 million during the year, which ended 30th of September 2019. Four, that is number six, not note number four. We are told intangible assets consisting of trade licenses being amortized over 5 years had a carrying amount of 240 million. And this was allowable for tax purpose in full 2 years ago. So number seven, income tax rate 30%. So what are we required to do in Roman 2? Or actually in Roman 1 of the question, we compute the relevant temporary differences, 8 months, and Roman 2, we make the necessary journal entries to record the changes in the deferred tax liability. So we start with the Roman 1 there, whereby we are required to compute the relevant temporary differences, or basically the relevant TD, temporary difference. So in this case, what you just need to recall is what is temporary difference. In other terms, you just need to remember how do we compute this temporary difference. From our discussion, we have said temporary difference, this is equal to the carrying amount of an asset or liability minus the tax base. Minus what? The tax base. So basically what we need to do is we go through the information we are given in note number 1 all the way to note number 6. We are given a number of items of assets and liabilities. We will identify, we will determine the carrying amount of the tax base, and then we get the difference, which is temporary difference. Also, we have to recall we have 2 types of temporary difference, which is taxable and deductible. So what we need to do here is to have assets stroke liabilities, a column for assets stroke liabilities we're given from note 1 all the way to note number 6. Then we will have a column here for carrying amount, Then we have the next column, which will be for tax base. And the difference between these two will be the temporary difference. Difference. And then if we check on the values which are given there, our values are in million of shillings. So that means that we will also work with our figures in million of shillings. We work with all our figures in million of in a million of shillings like that. We work with all our figures in million of shillings. So let's start with what you're given in note number one. Let's go to note number one. In note number one, what are we told? I hope you're back in note number one. Let's go to note number one. Let's go to note number one. So in note number one, we are told that the company has got available for sale financial assets with a carrying amount of 80 million and financial assets at fair value through profit and loss of 40 million. Both financial assets reported losses, both financial assets reported losses of 8 million each during the current year. During the current what? During the current year. So in relation to, or in that note number one, we are given financial asset. I hope you can be able to recall in the topic of financial instrument, we said financial asset is basically investment in equity instrument or investment in debt debt instrument. And actually we talked about three types of, or three categories of financial asset. Financial asset at fair value through profit and loss, financial asset at fair value through other comprehensive income, and financial asset at amortized cost. Sasa, yes, but if you check in our questions here, basically we have two financial assets. The first one is called available for sale. Now, if you can be able to recall under that topic of financial instrument, we never came across something like this, financial asset available for sale. But this was a name which was used under this standard, International Accounting Standard number 39. And I hope you can be able to recall I mentioned something to do with this standard, International Accounting Standard number 39. We say this standard was superseded. In other terms, it was scrapped and replaced by IFRS 9. So currently, these financial assets are the ones we refer to as the financial asset at fair value through other comprehensive incomes. So that is the current name for this financial asset. Equally in the same point, we have the financial asset at fair value through profit and loss. Now we have their carrying amount. So the carrying amount for the first one, this one is 80 million. And the carrying amount for the other one is, for this financial asset at fair value through profit and loss, is what? Is basically what? 40 million. So I'll give you some points which are important, maybe, which you can also use in answering other questions here as we move. I'll give you some few notes here just to guide you in terms of knowing the carrying amount, the tax base of various items of asset and liability. So I'll give some notes here. So the first one I'll give in relation to this financial asset. So financial asset at fair value through profit and loss, and also financial asset at fair value through other comprehensive income. Now, the carrying amount for this asset is always equal to the fair value. This is something we know from that topic of financial instrument, that these two financial assets are supposed to be recorded in the company's balance sheet, in the company's statement of financial position at their fair value. Their fair value is the carrying amount. Is the carrying what? Amount. What about the tax base? Their tax base is always equal to the cost. How much amount was incurred by the company in acquiring this financial asset? Sasa, that's what you just need to remember. Carrying amount, fair value, tax base is the cost. Now, what basically we are told is that these are the fair values. In that point, basically the last sentence of note one, we are told both financial assets reported losses in fair value of 8 million. In other terms, their fair value reduced. So it basically means that if, for example, this is the fair value at the end of the, or actually this being the fair value at the end of the year, it was not acquired by the company at this amount. Because remember, we say that whenever the company is acquiring this financial asset, these shares, the company acquire them, buy them at their fair value, at their current market price. But you're told the current market price for this reduced with 8 million. Can you be able now to determine the cost at which they were bought? If their market value reduced with 8 million, can you be able to determine the cost which was incurred by the company in acquiring them? Automatically, yes. Can you be able to do that? Either. Can you be able to get to know the cost which was incurred by the company in acquiring those financial assets? Yes, we can be able to get the cost, because if their market value reduced with 8 million, automatically they were acquired at a value which is higher than this. So what we need to do to get the cost, which is the tax base, we will add 8 million here. 8 million, and also the same case here, 8 million. Sasa, yes, that will give us the cost because their market value reduced with 8 million. So then we get the temporary difference, which will be, we are using this formula, this minus that. So this minus that, and I hope you can see that will give us -8. This minus that, which will give us -8. And basically what you have said is that if this happens to, or if this happens to be less than this one is called deductible temporary difference. In other terms, if you take this minus that and you get a negative figure, is the deductible temporary difference. The same case, that is a deductible temporary difference. But if you get a positive figure, is a taxable temporary difference. Let's move to point number 2. In point number 2, we are given something to do with the inventory. Even before you go through that point, I can also give you a note here in relation to the inventory. Inventory, we know that these are the assets which are held for sale in the ordinary course of business. So the carrying amount, this one is basically the lower of cost and net realizable value. And basically this is in accordance with the International Accounting Standard number 2. So we value the inventory. We record the inventory in the statement of financial position at the rate of the cost and the net realizable value. But what is the tax base? What do we take into account in taxation as far as the inventory is concerned? So the tax base, the amount of inventory for tax purpose is basically the cost, because basically what we know, the reason why a company will be having some inventory at the end of the day is because there were some purchases which were made. So we know purchases in taxation, they are deductible, they are allowable what? Expenses at cost. At what? At cost. So the tax base of inventory is what? Is cost. The carrying amount is the rate of those two values. So here we need to have the inventory. So the inventory, basically, we are told in note number 2, is shown at the rate of the cost and net realizable value, shown where? In the balance sheet, in the statement of financial position. The cost is 32. Net realizable value is 31.20. So we take the figure which is lower, which is basically 31.20. That is the carrying amount. That's what you have said there. But the tax base is the cost. The cost is 32. Is 32. So we equally get the difference. So you just, in addition to this, just remember that point. No need of cramming anything. Just remember that point which I've given you there. So what is the difference here? The difference between these two, is it 8 million? Yes, 8 million, which is basically a negative. And that is a deductible temporary difference. So we move to point 3, sorry. Point 3, we are given something to do with the receivables. I'll also give a note. Receivables, and also this applies to payables. So the carrying amount, this one is always the net amount. The net amount. What do you mean by the net amount? For example, the net salary. Net salary is basically your salary after all statutory deductions have been deducted. Deducted. The net amount you get. So receivables and payables are recorded in the statement of financial position at the net amount. For example, you know, receivables, we have to eliminate something called the expected credit losses. Expected credit losses, these are basically the losses which are expected to be incurred in what? In the future. So therefore, the carrying amount is basically the net amount, but the tax base, this one is equal to the gross amount. The gross what? Amount. The gross amount, the original amount of receivables or payables before any adjustment. Before any what? Adjustment. Simply because we know that the reason why we have receivables is because there were some credit sales which were made. We know credit sales is a taxable income. So payables is, we have payables. You see, payables is the amount of money to be paid to suppliers. This is as a result of credit purchases. Credit purchases, we also know in tax, is a taxable expense. Is a taxable what? Expense. Okay, so let's go through that particular point and you see what you're told. We are told receivables have a carrying amount of 2,000 after making allowance for doubtful debts of 80 million and the exchange gain of 160 million, which is unrealized. Unrealized exchange gain, this one is treated as an asset. Being an asset, in arriving at that figure of 2,000, it was added. But the allowance for doubtful debt of 80, in arriving at that figure of 20, that is 2,000, it was deducted. We don't even need to go to the last point. So we just need to know the figure for 2,000 is the net, because that is after making adjustment. It's after making what? The adjustment. After making what? The adjustment. So therefore, receivables, we have receivables here. Receivables here. And basically, we are saying receivables and payables. The carrying amount is the net. Is the net. 2,000, which you're given there, is the net amount. Is the net amount of receivables after making adjustment for allowance for doubtful debt and the exchange gain. So, but how do we get the tax base? Tax base is basically the gross amount, the original value. The original value. So basically, in arriving at this, we have said two things were done. The amount of 80, which is the allowance for doubtful debt. Nowadays, we don't talk of allowance for doubtful debt. Maybe this is something you'll come across in other subjects. Nowadays, we don't talk of allowance for doubtful debt, but we talk of expected credit losses. Equally, we don't talk of bad debt written off. Nowadays, we talk of credit losses. Yes, so those are maybe some terms you need to be aware of. You are likely to come across that in other subjects. For example, you'll do BDA after this, you'll be coming across these terms, credit losses. Credit losses, these are bad debts written off. This is what was previously known as the bad debt written off. So nowadays, equally, we don't talk of allowance for doubtful debts. Allowance for doubtful debts, we talk of expected credit losses.